Okay.
Section 8, P-TECH course number 3, Income Approach to Value. Income Approach Methods, Direct Capitalization, Traditional Method, Rental Income Multipliers, Yield Capitalization. Major economic principles underlying the income approach. Anticipation, value is measured by the present worth of all anticipated future benefits of a property. Future net cash flows are possible resale. Change, how will projected changes in the economy and neighborhood affect rental rates, for example? Projected changes in the expenses due to maintenance, taxes, and insurance, etc. Supply and demand, oversupply or a lack of demand will naturally lower income possibilities. High demand or lack of supply with raise income and value.
I don't know where you're reading.
Supply and demand. High demand or lack of supply with raise income and value.
Will raise income and value.
Steps to direct capitalization using IRV or IRV. Determine potential gross rent using market rent, PGR. Subtract vacancy and collection loss. Is that minus VCL or dash VCL?
Minus.
Equals effective gross rent, EGR, plus secondary income plus SI equals effective gross income, EGI. Subtract operating expenses minus OE equals net operating income, NOI. Select the capitalization rate, R. Divide the NOI by the capitalization equal value, V. Or PGR minus VCL equals EGR plus SI equals EGI minus OE equals NOI. NOI is then moved into the IRV formula, I divided by R times V. Imagine the horizontal line separating the income box from the rate and value boxes as if it were a math formula. To use IRV, we would calculate income divided by rate equals value, or income divided by value equals rate. Now imagine that the multiplication symbol is on the vertical line separating the rate and value. Multiplying rate by the value will equal the income. Terms associated with direct capitalization. Building capitalization rate, discount return rate plus recapture rate. Built up discount rate. One method of estimating a discount rate, 4 components: risk rate, safe rate, liquidity rate, and money management rate. Capitalized, to convert to value. Capitalization rate, rate used to convert estimated future income into present value. Contract rent, the actual rent as stated on a contract may or may not be market rent. Discount rate, the rate of return on an investment. Economic rent, see market rent. Effective gross income, PGR minus VCL plus SI. Effective gross rent, PGR minus VCL. Equity ownership, market value less debts on property, mortgages equals equity. Equity capitalization rate, equity income divided by equity value equals equity capitalization rate. Equity yield rate, the rate of return on equity capital, the investor's expected return on investment. Expense ratio, the percentage of expense in relationship to the EGI. IRV is the most accurate method of determining value in the direct capitalization. Basic formula is income divided by rate equals value. Land capitalization rate. The land capitalization rate is the same as the discount rate, the rate of return on the investment. Land income divided by land value equals land capitalization rate. Leverage, debt capital, the amount divided by ratio that is owed on a property. Non-liquidity rate, one of the 4 rates in the built-up capitalization rate. Liquidity refers to an investor's ability to convert the asset into cash. Market rent, prevailing rent in the market. Always use market rent and market expenses in calculations. Money management rate, the rate for managing the investment, part of the built-up discount rate. This is not the same as the management rate in the operating expenses. mortgage capitalization rate, annual debt service divided by total loan equals mortgage capitalization constant. It is the lender's capitalization rate. Mortgage constant, C mortgage capitalization rate. Mortgage interest rate, the interest rate stated on the mortgage. Net operating income, PGR minus VCL plus SI minus OE equals NOI. Operating expenses, annual reoccurring expenses necessary to maintain the property that owners typically pay. Only use market expenses, not contract expenses. Potential gross income, PGR plus SI equals PGI, or all the market income a property is able to produce. Potential gross rent, the total rent a property could produce at market rent with 100% accurate occupancy. Recapture rate, return of an investment, the amount recaptured annually from the NOI for wasting assets. Reserves for replacement, an annual allowance for replacement cost of short-lived items that will not last the remaining economic life of the property. Risk rate, a rate included in the built-up discount rate that considers the risk of the investment. Safe rate, a rate included in the built-up discount rate, usually equal to a T-bill or other safe investment rate. Secondary income, income to the property that is not rental income. Vacancy and collection loss, loss from two separate sources usually expressed as combined percentage, one from lack of occupancy and one from bad debt. Always use market rents and market expense. Do not use contract rents or expenses. Texas appeals courts have ruled that market rent is appropriate regardless of the lease contract on a property. Texas Civ at 590 SW 2D 793. Potential gross rent development. Example lease types and their typical conditions. Percentage usually has a base rate and then the tenant pays a percentage of income, common in retail leases. Graduated, the lease calls for a specified increase in rent level, specific time periods. Index, rent adjustment are based on published indicators such as the CPI. Triple net, the leasee pays all maintenance and expenses including taxes and insurance. Example, we will use this information later.
What are you trying to do? I'll get it.
Not allowed to touch.
Okay, go.
Index rent adjustments are based on published indicators such as the CPI. Triple net, leasee pays all maintenance and expenses including taxes and insurance. Example, we will use this information later. Office market rent, 10,000 square feet times $1 PSF per month equals $10,000 per month or $120,000 annually. Vacancy and collection loss. Vacancy loss is based upon the market vacancy of a property type in a specific market. Collection loss is the typical amount lost due to bad debt. These two percentages are added together for one deduction. Secondary income. Secondary income is income produced by the property that is not rent. Examples of secondary income include the following: garage rental, clubhouse rentals, concierge service, and vending machine income. Allowable operating expenses. Below are examples of operating expenses that may be deductible. Always use expenses that are recognized by the market, not the contract that is on the property. Expenses may be stated as a percentage of the EGI and called an expense ratio. Advertising, necessary to keep the building occupied. Furniture rental, lobby furniture or office furniture. Insurance, fixed expense, usually deductible unless the lease calls for the leasee to pay the expense. Janitorial, cleaning services. Lawn service, maintenance, lawn and shrubs. Management, usually a percentage of EGI. A fee paid to manage the property can be paid to an outside property management company. Expense to the owner of the property. Miscellaneous expenses. Small expenditures for test purposes always allow this expense. Payroll, caretakers of staff on site to manage the property, repairs, minor repairs, reserves for replacement, short-lived items in the cost approach that have a remaining economic life that is less than the improvement remaining economic life. Replacement cost is estimated and divided over the estimated life of the item. 1 year's cost of this short-lived item is deducted as an operating expense. Security services, building security, supplies, office supplies, and other supplies used on the site to maintain the property. Taxes, fixed expense, usually deductible unless the lease calls for the leasee to pay the expenses. Utilities, power, gas, water. Disallowed expenses. Many of the expenses below may be found in an operating statement submitted by a property owner. We only consider expenses that are directly related to the maintenance and operation of the property. No capital expenditures are allowed. The IRS allows accelerated depreciation that does not consider the actual physical economic life of a property. Other expenses in an owner's statement may be related to the business but not to the real estate. Debt service. This expense is to the owner, not to the property. Depreciation consideration is included in the recapture component of the capitalization rate. Dues, business expense, not an expense to the property. Income tax, properties do not pay income tax, people pay income tax. New improvements, capital expenditures can be divided into two categories. New improvements are not necessary to maintain the property in its current condition. Repairs and replacements are in reserves for replacement. Travel, the property does not need to travel. Vehicles, if the owner's choice is to provide a vehicle for the property, it is not necessary to maintain the property. Example problem. Office building example above continued. 10,000 square feet times $1 per square foot times 12 months equals $120,000. In your market, rental rates are $1.25 per square foot per month. The vacancy loss rate is 10% and the collection loss is 5%. Secondary income is usually 3% of potential gross rent PGR. Management is 5% of effective gross income. Building owners typically pay janitorial and fixed expenses. In this market, tenants pay utilities and building security. The operating statement below was submitted by the property owner. Using the information below, rework the operating statement below using the market information above.
You don't have to do that. They made a mistake in it anyway, because in the reworked statement, janitorial should have been included into the allowable expenses, and they didn't, so we had to change it.
Using market rental information, correcting the reserve amounts, and removing business expenses from the operating statement can make a substantial difference in the net operating income of the real estate. Capitalization, cap rate, development, understanding cap rates. The term capitalize means to convert into value. Cap rates can be developed using a variety of methods. The basic assumption of direct capitalization is that the investor will hold the investment until the improvements have wasted away due to physical or economic conditions. This means the improvements will have zero resale value at the end of the investment, and there will be no recapture on the investment at the sale. The cap rate must consider the return on the money that is invested and the return of the money invested in the wasting assets. Land earns return on the investment, also called the discount rate. Improvements earn return on and return of the investment, called the building cap rate. The discount rate, return on, is determined by one of the following methods: summation method, theoretical approach, safe rate, risk rate, non-liquidity rate, money investment management rate, market analysis abstraction, Method using comparable sales. Income to recapture is deducted from property income first. Remaining income is discount on return on the whole property. R discount equals I discount divided by property. I discount equals I NOI minus I recapture. Recapture rate. Return of is determined by one of the following methods. Straight line recapture, remaining economic life method, 100% recapture of the total investment in the wasting assets, not land, divided by the remaining economic life of the improvements. 100% divided by remaining economic life equals recapture rate. 1.00 divided by 20-year REL equals 0.05 or 5% per year recapture. The investor needs to recapture to get 5% of the investment in the wasting assets every year in the NOI. If 150,000 were listed in the improvements wasting assets, then 5% or 7,500 of this value would need to be recaptured annually. Market analysis, abstraction, method using comparable sales. Recapture equals I recapture divided by V building. I recapture equals I NOI minus I return. Methods of developing cap rates. Market derived overall capitalization rate. ROAR equals I NOI divided by V property. Example, calculate the overall cap rate using the market analysis method. Property A sold for $125,000 and has a total net operating income of $15,000. The solution, ROAR equals I NOI divided by V property. R equals 15,000 divided by 15. R equals 15,000 divided by 125,000. R equals 0.12 or 12%. Band of investment methods. Land and building method. Property is separated into the physical components of land and building with rates that apply to each component. Assuming the land represents 20% of their overall value, the discount rate, land rate, is 8% and the recapture rate is 5%, and the OAR calculation is as follows. Land, 20% times the rate of 0.08 equals 0.016. Building is 80% times 0.13 rate equals 0.104. Add them up to 1, and the rates add up, the 0.08 and the 0.05, and they add up to 0.12.
No. The 0.016 for the land OAR, and the building OAR is 0.104 for the overall cap rate of 12%. You're adding that 0.016 plus the 0.104. That's okay.
Mortgage and equity method. Property is separated into financial components of mortgage and equity. Lenders have return requirements on loans just as investors have return expectations on equity. These components can be used to develop an overall rate. Mortgages have a stated interest rate to the consumer, but that is not the actual return to the mortgage company or bank. The mortgage capitalization rate, also called the mortgage constant, is used in this calculation. The mortgage constant is the amount to amortize or pay off a loan. It is calculated by adding 1 year's mortgage payments and dividing by the total amount of the loan. This is the annual return to the investor. Do not use the mortgage interest rate as in the calculation. Properties may have multiple mortgages and all must be considered in the calculation of the rate. Property is 100% and equity is the remainder after deducting the percentage contribution of the mortgages. Mortgage number 1 is 0.60 times the rate of 0.086667 is equal to 0.052. Mortgage 2 has a 0.15 percentage times a rate of 0.161113 equals 0.0242. The equity is 0.25% times 0.15 rate equals 0.0375. Add up the percentages to 1. The solution adds up to 0.1137.
In this case, you could read my scribble. OAR. At 0.1137 overall cap rate.
Okay. Loading the cap rate. Adding the tax rate to the cap rate is referred to as loading the cap rate. If taxes are deducted as part of the expenses in an operating statement, the cap rate will not be loaded. If taxes are not deducted in the operating expenses, the cap rate needs to be loaded to consider the effect on taxes on the value of the property. In the mortgage equity example above, the cap rate is 0.1137 or 11.37. Adding tax rate of $1.75 would change the cap rate as follows. Convert $1.75 to decimal by dividing by 100. 1.75 divided by 100 equals 0.0175. 0.1137 unloaded cap rate. 0.0175 tax rate. 0.1312 loaded cap rate.
You add those two numbers together.
I didn't know. There's no sign.
Yeah, there is no sign, but that's what you're doing. The 0.1137 is unloaded. There's no tax rate in it. It's just the rate of the mortgage and the equity, and then the tax rate. Add the two together, and you get the 0.1312.
Rent and income multipliers. Rent and income multipliers are useful tools when appraising small commercial and residential properties. We use some of the same levels of income that we developed in the direct capitalization method to obtain NOI. PGR minus VCL equals EGR plus SI equals EGI. Notice that the formula stops at effective gross income. Whenever NOI is known, the appraiser will always use the direct capitalization, ERV, or yield capitalization. When using multipliers, always use the same level of income against the appropriate multiplier. For example, potential gross rent multiplier, PGRM, times PGR, effective gross rent multiplier, EGRM, times EGR, effective gross income multiplier, EGIM, times EGI. Calculating a rent or income multiplier from comparable sales will give us information to estimate market value for our subject property. Sale. A rental residence sold for $225,000 with a monthly rent of $1,750. VCL in this area is 12%. Calculate a monthly and annual PGRM and an EGRM. Monthly PGRM $225,000 divided by 1,750 equals 128.51 PGRM monthly. EGRM $225,000 divided by 1,750 times 0.88 equals 146.10 EGRM monthly.
That 0.88 comes from the vacancy and collection loss.
The annual PGRM is 225,000 divided by 1,750 times 12 equals 10.71 PGRM. EGRM is 225,000 divided by 1,750 times 12 times 0.88 equals 12.18 EGRM. What is the value of the subject if it has a rental rate of $1,800 per month? Monthly PGRM 1,800 times 128.51 equals 231,318 estimated value. EGRM 1,800 times 0.88 times 146.1 equals 231,422 estimated value. Annual PGRM 1800 times 12 times 10.71 equals 231,336 estimated value. EGRM 1800 times 12 times 0.88 equals 12.18 equals 231,517 estimated value. Effective gross rate multipliers, EGIM, work in the same manner except the appraiser must remember to add the secondary income before making calculations. Usually, gross income multipliers are annual, not monthly. Read the question carefully. Example, a small office building has a monthly potential gross rent of $2,500 and an annual secondary income of $1,200 for garage parking. The property's sale price was $275,000. What was the annual gross income multiplier? PGR 2,500 times 12 equals 30,000. Annual gross income equals 1,200. Potential gross income is 31,200. Sale price $275,000 divided by 31,200 PGI equals 8.81 PGIM. The subject property has a monthly rental rate of $2,150 and an annual secondary income of $1,350. What is the value of the subject using the information above? PGR is 2,150 times 12 plus 1,350 SI equals 27,150 times 8.81. And there's no answer.
Nah, it's okay. No biggie.
Yield capitalization. Yield capitalization is also used to convert future benefits income into present value, but it is significantly different than traditional or direct capitalization of income. Discounted cash flow, DCF, is one form of yield capitalization and the one most used in mass appraisal. The Elwood method is another form of yield capitalization, but is far more complicated than a DCF analysis. Direct capitalization is very useful in stable markets, but a DCF is able to consider varying cash flows that are typical in rapidly changing markets. Discounted cash flow analysis. A DCF makes several assumptions concerning a property that is different from direct capitalization. The property is owned by an investor with a specific holding period. At the end of the holding period, the investor will sell the property. The property will undergo changes during the holding period that will affect the NOI. Long-term leases may expire, the neighborhood may undergo a rapid change, the property may need substantial expenditures to stay competitive with the surrounding market. A new public or private improvement may increase the neighborhood's desirability. The ratio of mortgage and equity will change over the investment period. DCF uses a yield rate to estimate the value of the cash flow, not a cap rate. Definitions. Holding period. The time that a typical prudent investor will retain ownership of properties comparable to the subject. Reversion, a lump amount the owner will receive in the future, also the process of converting future value to present worth. Steps to the DCF. Estimate the length of the holding period by a typical investor of this type of property in the market. Estimate the NOI for each year of the holding period. Determine the proper yield rate. Yield rates are comprised of a discount rate and the investor's expected return on the investment. Select a cap rate for the reversion, the sale of the property at the end of the holding period. Determine typical marketing and closing costs associated with selling the investment. Each year's estimated future NOI must be reverted back to the present value using a present value of dollar factor. See 6 functions of dollar table. Use last year's NOI to calculate the estimated sale price at the end of the investment using a cap rate. Revert this future value into net present value. deduct cost of sale from the estimated sale price. Total the discounted income streams to estimate the total present value of the subject. Example of DCF. In the following example, we will estimate the market value of an apartment complex. We know that the owner expects to keep the property for 5 years, and we know that a reversion is expected at the end of the holding period. The yield rate is 14%, cap rate 8%, and the cost of sale is 10%. Following is a list of irregular income stream NOI for each year of the holding period. Year 1, $75,696. Year 2, $84,885. Year 3, $62,780. Year 4, $79,987. And year 5, $92,600. The next step is to estimate how much will revert to the owner at the end of the holding period when the property is sold. To do this, we capitalize the 5th year NOI by direct capitalization using an overall rate of 8% and a cost of the sale of 10%. Estimated reversion at the end of the holding period. 92,000 NOI divided by 8% cap rate equals 1,157,500. Less 10% cost of sale minus 115,750. Estimated net sale price 1,041,750. All of the future income streams are discounted back to present value by applying a present value factor. Year 1, the income stream is $75,696. The present value of the dollar is 0.9259.
Look at you.
Present value is $70,087. Year 2 is $84,885. Present value of the dollar is 0.8573.
You can skip on down to the reversion if you want.
Reversion income stream is $1,041,750. Present value of a dollar is 0.6806. Present value is $709,015. The estimated value is $1,023,523.
Do you get how to get that number?
Nope.
You're adding up all those present values.
Okay. I need a break.
Last page.
7 basic factors that influence property values and how they influence capitalization rates and yield rates. Conversion of debt to equity. A yield rate considers conversion of debt to equity over a property's holding period, but a cap rate only uses 1 year's income yield rate. Anticipated depreciation. Cap rates and yield rates account for different types of depreciation. A cap rate accounts for the depreciation of wasting assets by including a recapture component. It does not account for anticipated declines in property value over the holding period if those declines arise from general economic conditions. A yield rate does not include a component for recapture but does not account for anticipated changes in property value over the holding period in both the NOI and the reversion, cap and yield rate. Non-liquidity. Both yield rates and cap rates account for non-liquidity. A non-liquidity factor makes up part of the return rate, which is part of both the cap rate and the yield rate, cap and yield rate. Risk makes up part of the return rate. Discount or return rates are part of a yield rate and cap rates, cap and yield rate. Length of the holding period. Length of the holding period does not influence overall cap rates, which apply to 1 year's income. A yield rate is based on the anticipated holding period yield rate. Ratio of wasting to non-wasting assets. The recapture rate is included in the overall cap rate. Recapture of the investment is the reversion sale of the property when using cap rate. When using yield rate, cap rate. Recapture of short-lived assets. Recapture of short-lived assets has no influence to either the yield rate or the cap rate. Recapture of short-lived assets is in reserves for replacement in operating expenses, neither.
And all the problems in the cost and income section are just math problems, so we did not read those. Any final words?
Nope.